Hey, ladies and gentlemen, welcome to another episode of the Beyond Seven Figures podcast. Let me tell you a little story about my guest today. So, I'm part of a mastermind that involves seven, eight, nine-figure entrepreneurs, some of the most brilliant minds on the planet. When I was first introduced to this mastermind group, in this group, you begin to see which members of this group also have influence over other members. And so you have group full of high performers, and then you have those high performers who are being influenced by, I guess, what I would call like the super high performers, the positive deviants, so to speak. One of those positive deviants is the guest today. See, those high earners are not only trying to find more ways to make more money, but they're trying to find ways to keep the money that they have. And so not only is he just great at being able to create and capture and keep wealth, but he's an entrepreneur himself. Many of you would have heard of the company Wealth Factory. That was a company that he started himself. And over the years, he's wrote multiple best-selling books, 9, I believe, including his most recent one, Money Unmasked. He's got other books that you might be familiar with. So you're going to listen to today's podcast, and you're going to have a totally different perspective on money than you had before you started. So without further ado, Garrett Gunderson. Dude,
That's a great intro, man. I can only mess it up from here, basically.
it's some of the people in the board of directors meeting that we had, they've gotten a lot of like really incredible advice. They're super, super, super high earners. In the nature of my company, Predictable Profits, for me, it's always about making money, making money, making money. And we're always seeing more money. And so there's always this gap between where I'm at and where that next level is. I tend to live a lot in that gap and always kind of feel like there's another level. And it wasn't until meeting you and having a conversation with my kids that I realized that I'm actually a lot wealthier than I am, because I measured my wealth by the thickness of my wallet, not by what matters most.
The thickness of your wallet versus the depth of your experience in life and with family.
So talk to me about that more. And why has that become such a core focus for you as opposed to just the thickness of your wallet?
I wish that I was just so damn good at this that it never would swayed me, or I was just enlightened enough that I always saw it this way, or that I was always dialed in on this side. The bottom line is there's a lot of like where people are versus where they want to be that is very false. And it's human nature, or at least in my estimation, it's human nature to compare ourselves to others. And so somehow it's been indoctrinated that in money, it's a win-lose game. One person gets the money, the other person doesn't have the money, as if money were finite. Like, and what I mean by money is not really finite, because A, it's just a conceptual thing that we're making an agreement around, but B, money exchanges hands multiple times. It doesn't just die off or go away. It gets spent, someone gets it, they get to spend it again. So the more times that money circulates, or what we would call exchange through serving others and solving problems and adding value, the more wealth is created. Like, people think that contentment is negative, because if you're not growing, you're dying. And in some ways, that's about learning, and that's about discovery, and that's about healing. But if it's only about profit, in dollars and cents, it could be misleading. Because I say it this way: money is an amazing companion and a terrible solo artist. If we're like, hey, money, make me happy, money doesn't have the ability to buy happiness. It can only rent happiness. And so even if we have all the visual trappings of that, we've got everything figured out, is that something that deep down we're validated in who we are, regardless of that external circumstance, and in what we do on a daily basis, because it's driven by purpose, by love, and by connecting with the people who matter most. It doesn't have to be either or. It's just that I'm more likely to get in sadness and comparison when I'm measuring net worth and these external validators, and they typically fulfill us if we haven't accepted who we are and done the inner work to love ourselves and to appreciate what we have with a sense of gratitude and that word again, contentment. So it's human nature.
One of the last times that you and I were together, I called my kids from the event, and I asked them. I said, "I'm curious, in comparison to them, how would you rate your quality of life? Compared to your quality of life?" And without skipping a beat, my son and my daughter said, "We have the highest quality of life of anybody I know." And I said, "What does that mean?" They go, "Well, you support us on everything that we want to do." I'm like, you know what? I I really feel like I'm winning right now. I feel like like I've reached a big goal.
Well,
I felt so fulfilled. It was amazing.
so this is my entire message of I have a theatrical keynote, and this is the message of Money Unmasked when it comes down to it. When you design a game worth playing, when you enjoy the process along the way, you've already won. Like whatever outcomes and destinations that come, you've already won. But like when you're doing the work that you enjoy and when you're investing time with those that you love, you've already won. It's not like that is so different than how we've been taught, I think, because we're so taught to be like how much revenue and growth and like what I like about predictable profits is if you have recurring revenue that's predictable, man, that already one feels even better because you know like you have tomorrow to do whatever you want to do. So if you combine the economic independence and predictable profits with the love of yourself and the people that you care about and enjoying the life along the way, you've won the game. You know, and the problem is most people are never going to win the game because the game is always elusive. It's always in the future. It's always they get there and then it wasn't enough. And all they do is get these short bursts of enjoyment. So the fact that you're there, that's the game. That's the game. Like you've created the life you don't want to retire from.
What would your life look like if you built a life that you never wanted to retire from? What
Right.
would it have to look like? You're only given one day to do whatever you want, but you have to design your ideal day, the quality of our life, the people we want to associate from, the way that we spend our time. And it does make a really big difference. There's going to be some of our listeners who are like, I don't know if I get this. Like, this doesn't really resonate. And that's probably a good thing because you haven't hit rock bottom yet, or you haven't been truly unhappy. But until you get to a point, and hopefully you never do, where you're truly unhappy, then you realize how much you would be willing to genuinely give up in order to get back to being happy.
Look, in the children's book that I did, the first message is, hey, when it comes to the basics, I can make you happier. Right. And what that means is like people are going to be happier if they have food and shelter. Yet it says, no matter how hard I try, I can't make you happy. That's the next line.
Yep.
So it's like, and look, this is crazy to say. The least happy I've been was when the most money was coming in from the company I sold on a licensing deal without me having to do hardly any work. But when I had plenty of money coming in, what I found was I didn't want to not do things.
Yeah.
And so when we can find that crossroads of like something that's compelling and exciting that we can actually get paid for, like that's a pretty amazing sweet spot. And the thing is, I just think it takes time to build some of that, A, to discover it ourselves. But the key is get economically independent where you have enough cash flow to cover your expenses, but then swing for the fences in your vision. Then double down on your purpose. Then know that your foundation is handled, and that's just the beginning, not the end. The way that people are trained is that retirement is where they want to get to in the end, but now they stop working. Why do we want to stop the world of value creation if that value is consistent with who we are? We only want to stop the world of value creation when it's against who we are, doing
Yeah.
things that we hate in the name of money. And most of the world has just been unwilling to do that hard work. They
Yeah.
just skip the steps. They think if they get a degree or they get benefits and they just shortchange their life to sacrifice. But money's not strong enough to make up for that difference. It takes some patience to build something like that.
So, how I mean, you've written 9 plus books on the subject.
Yeah.
So how do
It's about first understanding that the goal and the objective is financial independence, not retirement. So we make that first distinction so that we have a different framework. And then the second piece of the framework is we agree that it's about cash flow instead of accumulation. Most people are accumulating for 30 years. They don't know what's going to happen over the next 30 years. So if it's going to be about cash flow and economic independence, the first step is create an automated structure, that automation that sets money aside so you pay yourself first. The second step is find ways to plug financial leaks, be more efficient, boost the bottom line so that that money automated doesn't come out of your lifestyle. So it's about finding money and then putting it back into your life. And then when that's automatically there, we automatically save, build up a peace of mind fund where we've got enough liquidity to handle health challenges, economic turmoil, life changes, moves. And now we really focus on our investor DNA so that you could grow your income because you understand sales, you understand marketing, you understand fulfillment, you understand communication, you understand emotional intelligence. Investing in that ongoing is going to make a big difference. Then, number two, investing in our quality of life because it's not wanting to burn out, it's treating yourself as your greatest asset. And then, third, it's what are the cash flowing investments that will help us because we're going to make more money, keep more of the money we make through efficiency, then grow our money through our investor DNA. And that
So wait a minute here. Financial advisor would say, no, 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 no. You've got to diversify and you got to throw your money into the stock market and mutual funds and everything else. And you're saying, no, start by investing in yourself first. Did I understand that correctly?
Yeah, and I get it because what we've been indoctrinated with is what if you didn't go to an Ivy League school? These people on Wall Street have gone to Ivy League. They're smart. They know technical analysis. And even though they might be able to pass tests that you can't pass, and maybe they do have an aptitude where they can study and learn more, what they don't have is your own sole purpose, SOUL, your values, your abilities, and your passions for the highest context of living. So the way I believe in growth is you grow your income and then you plug your financial leaks. That's way more growth than risking your money. I'm rewriting What Would the Rockefellers Do, my most popular book. It's going to be coming out called What Would the Wealthy Do because it's got a little bit more case study and numbers to it. But the chapter that just still resonates more than any other chapter is we do a study of someone making 100 grand a year with a 5% increase over 30 years. That's $12.9 million. We start looking at other factors like fees with investing. We look at other factors like, insurance costs, which we haven't even talked about in that study yet. So people don't even have to become financially savvy investors if they're willing to figure out their skill sets and make more money and have basic ideas of how to keep more of what they make. The grow your money is the least significant of the three for someone that just wants to be financially independent. Now, look, if you want to be a billionaire, you probably got to learn the grow your money thing quite a bit because now you have a lot to deploy. But what I find is some of those billionaires are still really tied up in just their businesses, not in like a bunch of diversified portfolios. Their diversified portfolios are other companies that they own, not stock portfolios that they have no control over. Yeah.
So it's about not necessarily growing the money, but it's about being more efficient in keeping more of the money that you have.
Yep.
So what where are people being inefficient? And then, how do we become efficient?
There's four I's to efficiency: IRS, interest, investments, and insurance. So the number one place where people are inefficient is taxes. They don't proactively, do what they're supposed to do with their taxes. They get refunds, which is an interest-free loan to the government. They miss deductions. They don't know how to reclassify their income. So it's more passive for tax purposes, which can avoid up to 15 points. But the problem is most people are dealing with historians that just file their returns, not navigate the tax code to tell them what they can and can't do to properly navigate that and keep more of what they make. That's the number one culprit.
And
Interest. Yeah.
what book did you write that, because I know everybody, including myself, is going to want to dive deeper into that. Which book of yours goes into
The,
that part of it, the tax
I
strategy?
mean, I'm shooting myself in the foot here, but if you go to my YouTube channel for free and watch my tax videos, they're actually better than any book I've written on that topic. If you're on my newsletter, I just send it out once a week digitally. I'm always giving tax strategy on that, garrettgunderson.com/quiz, take the quiz or /offer, grab a couple of my books for free. And then you can get that advice. But really, my YouTube channel does the best because a lot of times it's sitting down and explaining it. I just talked about this at Lifestyle Investor and they just got me the videos. We're going to chop those up, put them on YouTube. That's like going to be really great tax advice in those videos for sure. So, yeah,
Awesome. So I being IRS, then the
yeah.
next I.
Interest. And there's three R's for interest. Should you reallocate funds? Should you renegotiate interest rates or restructure loans? So, reallocation of funds might be someone's got a 10% loan and they're only earning 5% of their money. Reallocation, that's the first one. The second one is renegotiation. I mean, if you have the right credit, the right collateral, the right connections, or the right cash flow reporting, or a combination of the four, you can lower your interest rate substantially. I know people that used to have a paid off car and they'd have this 19% credit card. I'm like, you can go refinance your car back in those days for 1.9% and pay off a 19% interest rate credit card. By the way, an installment loan on a car will boost your credit score. A fixed loan like that boosts your credit score as you pay it on time. A maxed out credit card lowers your credit score because of your utilization rate, that
Mhm.
loan to value. So by actually raising your credit score, you might be able to go back and then do the last one, which is, refinance loans at a better interest rate
Yep.
and maybe even pull in non-tax deductible loans to tax deductible loans or better favor terms like a mortgage back in the day versus student loans, like other loans. There might be ways that you could combine those, now have it all be a tax write-off on the interest and have a longer term so you have more control over your cash and improve your cash flow substantially.
Got it. Awesome. So we have IRS, interest.
Like every one of my books talks about the interest side. I mean, probably the later the book, like, you know, Money Unmasked, my newest one, is going to be the best at talking about that, where it's probably just barely mentioned in Killing Sacred Cows because I didn't know how to articulate it the level I do today. So that there's plenty on that interest side.
Got it. So what's the third eye?
Investments. There's two factors here. Number one, most people don't protect the downside of their investments. So their investments can go down substantially. You can have that automatically trigger to move to cash. So then you can let the market finish its free fall and then choose when to get back in. So that would be one. But the second thing is, I'm like a financial detective finding hidden fees. And so if you look at all those fees, they make a huge difference. But we're not just talking percentage, we're talking about the realization of the net dollars and cents that you earn. And so finding where those fees are non-performing and removing that drag will help you to accelerate your results long term. So
Wow.
that's the factor there. Yeah.
Awesome. Okay. So then
Insur-
investment. And the last eye is
Insurance.
insurance.
So very simple. Insure the catastrophic, never the inconsequential. Something is inconsequential if you could pay for it today and go to sleep tonight. So
Yeah.
I want to make sure it's a claim for something catastrophic, like insure the catastrophic, which means raise deductibles, change elimination periods, depends on which type of insurance we're talking about, where you
Yep.
can handle the basics out of pocket and then only insure the major things and then transfer risk that way. So higher deductibles on car insurance, homeowner insurance, longer elimination periods on disability insurance, having health savings accounts, that kind of stuff with health insurance. So these things that give you more options to pay out of pocket for the small things and then transfer the catastrophic risk means you're getting way more bang for your buck because the most expensive dollar insurance is the first dollar. The least expensive is the last dollar. But it's more catastrophic if I just raise my deductible and change the limits of liability. So it's just a different look of how to manage risk.
But I know we're pushing against the clock now. Whole life insurance is usually considered an investment. And, there's paid up additions and all that other stuff. Does that fall a little differently? Is that more an investment bucket than it is an insurance bucket?
It's a savings account, is how I look at it, with benefits if designed properly.
Mm.
Now, some people really have a tendency to not like whole life because of certain people out there.
Yep.
So they'll say, just my term, invest the difference. I look at like whole life as a place I store my cash that's an alternative to the bank for my non bills. Like I put money in a bank to cover bills for 30 days at a time. But the insurance companies have proven to be much more stable than the banks.
Mhm.
We saw in '08 tons of banks went under. We know the three big banks that went under in 2023. But what big insurance companies went under when we're talking about life insurance? Mutual participating companies, none.
None.
Like,
Right.
so we're going with a more stable entity. The problem is it takes a little bit longer to capitalize. So if you're putting money in here versus a savings account, you'll be better off with a savings account and term insurance for the first several years. But if
Yep.
you properly design this, like you said, with paid up additions, after a few years, this should be competitive with your bond portfolio, with your money markets, with your savings accounts but now you have a death benefit. Now you have liability protection. Now you have riders that allow you to use your death benefit for long-term care. Now you've got, protection from bankruptcy and tax. You could get that money out beforehand. You don't have to wait till 59 and a half. So it's more of a how it's structured in the overall picture. And I'm still believe like if you don't know what kind of insurance to get the right amount that would replace your income if you die and get term insurance until you figure out what's best for you. But I am a proponent personally in my life of whole life. And I talk about it because I'm going to be in a documentary coming up. And I just got called about because of my book, What Would the Rockefellers Do? Where they're talking about these families that have been using trust and insurance to perpetuate wealth for generation after generation after generation. And so it's just a strategy that the wealthy have used. If you ever have a chance of having estate taxes, if you ever growing your business and have a chance of being sued, if you want to have a better place than a bank to store your capital, it is kind of it's not an investment because whole life just gets a fixed dividend each year and it goes up and down year to year. But once it's paid, it's guaranteed. So it's not going to outperform your business. More than likely, it's definitely not going to outperform your best investments, but as a storage facility for your cash that you can use when those investments come, it's a really great structure.
I had a gentleman meet up with me, and he was telling me, he works with centimillionaires and the whole deal. And he said, "Oh, what we do is, we want to make sure people don't feel guilty spending money when they want to leave money over to their heirs and whatnot. So we create, this insurance with paid up additions. So they can put all this money in there,
Yeah.
then they can spend all that money, and it will be replaced once they die, and then
Yeah. Wonder if he's a fan of what the Rockefellers do. That's a very big part of the premise of that book. So
I wouldn't be surprised.
yeah.
I wouldn't be surprised. All right, my man. So this is the Beyond Seven Figures podcast. If there was one tip, your biggest best tip, whether it's from an experience in Wealth Factory or in any one of your 9 books, what would you say would be the biggest best tip for our listeners who want to go beyond 7 figures?
To go beyond seven figures, it's I mean, for me, it's the process of creation. You co-create, you delegate, and then you collaborate. So collaboration is when you get multiple people involved for something bigger than what you're capable of doing on your own. But co-creation is where you find someone to support and inspire you to move beyond scarcity and have that accountability to get to creation. And you delegate with momentum, but delegate roles, ROLES, not tasks. So people own that role and then support the accomplishment of multiple tasks versus one, so you don't have to micromanage. But to me, it's finding your process and your flow to do that. So yeah, invest in yourself, but create the game worth winning. If you're playing the right game, then you're going to continue to grow. If your vision's bigger than your problem, 7 figures and beyond is possible. If your vision is if you lack a vision, your problems will eat you for lunch and you will run out of momentum.
Garrett just said one of the most powerful things in this whole conversation. If your vision is bigger than your problems, then you'll go much further. And that's the biggest difference between low earners and massive earners. Low earners tend to run away from their problems because their problems are much bigger than their vision. And so they run away and they're always trying to get away from them. But then big earners, they do something different. They create big problems for themselves. When you look at the wealthiest man in the world, Elon Musk, he's constantly creating big problems. He says, I'm going to colonize Mars. That is a huge problem. And he made it, he publicly talked about, I'm going to colonize Mars, or, other people doing space stuff or whatnot, or even, Mother Teresa was like, we're going to end hunger. That became a huge problem. Or the Dalai Lama, I want to, create peace. But in doing so, their vision is so big, they've accumulated massive amounts of wealth to support that vision. So it's true, having a vision far larger than your problems, which is going to be a correlation to how many people you want to impact, has a place for that vision. It's not going to be how much money do I want to put in my pocket. That's not a vision.
Right.
It's
That's a goal or an objective, basically.
right. It's
I
the
wrote about Mother Teresa in Money Unmasked, that very thing. She flew around on G5 private planes, so she was wealthy, but she just took that money and flowed through it to her mission: eradicate poverty and end hunger. Right. So, like, she had access to so much capital because if she walked into your office or mine, I would have given her money. But yeah, this is Mother Teresa. You give her money. She's got why? She's clear about her vision. She's ferocious about accomplishing it, and so yeah, like if we have a lot of clarity around our vision, people will come to our aid. That's the thing. People want to be led by a vision. They want to be about something that's exciting. And if your vision is to retire, nobody gives a shit. Nobody wants to work for your retirement. That's not exciting.
Yeah, it's all about creating impact in your community and your world and so forth.
Yeah.
So, Garrett, people want to learn more about you. I know Garrett Gunderson is a great place. You talked about Garrett Gunderson /quiz.
Get the children's book, man. For someone you love. It's the easiest way to get the message that I send out there. It's entertaining, it's educational, it's a great platform for a conversation. As an adult, you don't have to admit you didn't know everything that was in here. It's simple enough for any of us to understand. Yeah, engage with my books if you like this, or my blog, garrettgunderson.com/musings is where my blog's at. I mean, I write one pretty much every week. It's very vulnerable and open and filled with, I think, lessons. And so those are a couple different ways to engage.
I would highly recommend it. I particularly appreciated the newsletter you wrote about the difference between scarcity mindset and abundance mindset. I took different snippets of it and I shared it with my board of directors members as well because I thought it was a really, really nice reminder. So that wraps up today's episode of Beyond Seven Figures podcast. We covered a lot. We started today's podcast really talking about just living the life that you don't want to retire from and how there's a difference between wealth measured in the quality of your life versus wealth measured in the thickness of your wallet, and how many billionaires would be willing to trade their wallet for happiness and a reminder of what happiness was. So, the quality of life is going to be really important. We talked about other things like the four I's, IRS. Let's see. I know investments and insurance, and there was one other I, interest.
Yep.
There we go.
Those are all four.
So we talked about those four I's. We covered a lot. A lot. I think that we're gonna have to digest. We talked about vision and the importance of making sure your vision is bigger than your problems. And this is one of those episodes that I think many of us are going to go back and listen to, a couple times over. So, Garrett, again, thank you so much for being here. And he's got so many different resources over YouTube and so forth. I do highly recommend that you spend a little time and soak that in. It will pay dividends for you largely. So thank you for that. Also, as a reminder, for more tips, strategies, and information on taking your business beyond seven figures, also check us out at predictableprofits.com. Again, that's predictableprofits.com. So GarrettGunderson.com is where you can find more about Garrett. Follow him on social. This is Charles Gadet with my friend Garrett Gunderson, and I will see you in another episode.